All right, welcome everyone. Everyone can hear me, right? If you can just like put it in the chat or something, just so I know that you can. Okay, good. Thank you. All right. So today we're going to be going over short squeezes and small caps, which is what I really like to trade. I always think about trading like you have to find what you like or what suits you best. Like I know Hassan, he loves scalping like zero DTE options, and then I know some people entering the waiting room. I know some people like they have their own strategy. Some people like to play shares. Some people trade options 1 month out. Some people swing only. So it's depending on what you like to do. You just have to like test the waters and then see what works best for you. For me, I found my niche to be in short squeezes and small caps. That's where I ended up having the most success. So that's what I'm going to go over in today's lesson: how I find short squeeze setups, how I find small cap setups, how I use options flow, and how I put it all together to start trading. All right, so let's get started. First thing, what is a short squeeze? To understand what a short squeeze is, you have to start off by understanding what shorting a stock is, because how does shorting a stock cause a short squeeze? Like, how does it make it go up? So when you short a stock, you're essentially betting on it going down. But how does it work? So it works by selling the shares before you actually buy the shares. Now, it gets a little bit confusing, but let's take an example. Let's say I sold one share of Apple at $100. I'm currently negative one share of Apple, right? When it goes down to 80, I buy it back. So I have zero shares of Apple. I have not bought or sold anything, but I have the $20 difference between the 100 and the 80. But you're probably wondering, where did you get that one share of Apple to sell if you never bought it? You borrowed it from your broker. So you're borrowing shares from someone saying, hey, can I use this for a little bit of time? Doing whatever you want with it, and then giving it back to them. And whatever you do in that meantime is the profit that you get to keep. So if that makes sense. So this is a little diagram to show you exactly how it works. Uh, so the short seller borrows 10 shares of a stock, right? From the broker. They take it from your broker. This could be TD Ameritrade, Robinhood, Fidelity. It could be any of them. They sell it for $500, right? They buy it back in the market. The value changes in the market. They buy it back and then they return it to the broker, keep the difference. But what you should understand is that the broker is not going to do this for free, right? That's called the cost to borrow. They wouldn't just let you borrow it for free because in the stock market, nothing is ever free. So, yeah, that's called the cost to borrow. Sorry, people are still entering the waiting room, which is why I keep pausing. But what is a short squeeze? So short sellers profit from the price of the stock going down, but the issue is there's unlimited risk, as you can see in this thing. If the share price goes up, you can go minus 100%, minus 200%. So another and better way to short a stock is via put options. You buy puts. The thing with this is that your loss is limited to the amount you paid for the put option, right? But you also have to buy an expiry and you have theta decay and all the negatives that comes with options trading. So a lot of people tend to short a stock hoping or just making sure that their risk is managed. But a lot of times this can get out of hand. And this is where short squeeze comes in, right? So the loss is unlimited. Now imagine you short sold a stock at $3 and the next day it opens at $7.50. So what are you going to do? Because you're already down more than you have. So your broker who you borrowed from, they're going to call you because they want their shares back. And they say, you have to buy it back now. So you have zero shares and you can give me my share back. Right? And when this happens to a lot of people at once, it's what they call a short squeeze because these shorts are getting squeezed out of the stock. They are buying it and they're forced to close their positions because it's going up to a certain point that they're just not able to. Right? So how do you calculate the short percentage float? So like if a stock is 100% short of the float, that means every single share on the market is currently shorted, which is not good because once people start buying it up, people are going to start getting liquidated, right? If it keeps going down, that's good, but usually it doesn't happen like that. So when you have high short interest, it's basically the short interest as a percent of the float is the numbers of shares that's shorted divided by the free float of the stock. For example, if uh, Apple had a 1 million share float, it doesn't, but just an example. If Apple had 1 million share float and 800,000 shares were shorted, it would be 80% of the float is shorted, right? If that makes sense. Now, how do you use this, right? So when you go on a data provider that gives these short interest numbers like Ortex or S3 data or something, they'll give it to you as a percentage of the free float. For example, I've circled it here. 226% of the red box float is shorted, which is a lot. That means there's more shares that are being borrowed than there are actually available in the market. And since there are this many shares that are being borrowed, it's extremely hard for the broker to find them and then give them to you to short, which is why the cost to borrow over here is 832%, which is extremely high, right? So, what is considered a high short interest and a high cost to borrow? You might be wondering. So, this is my recipe for finding short squeeze picks. It's one of the things that I use. I'm always looking for stocks with short interest higher than 100%, a cost to borrow higher than 100%, because this means that a lot of the float is shorted. So when it starts going up, there's going to be a lot of people that need to liquidate their position and cause a squeeze. The cost to borrow being over 100%, because that also means that there is a lot of people, like there's not as many shares available for the broker to find, right? So if the broker can't find the shares, at some point there's going to be no shares left to short, and then they're going to have to give it back to the market. Next is share price under $10, and you're probably wondering why. And it's because when it's under $10, it's very easy for retail to pile in. And when retail, so if there's a stock at $3 and retail pushes it up to 4, everyone who was already short that stock at $3 is down. What is it, 30%? They're already down on their position, right? So when retail can pile in, they can really push up a stock, and it's much easier to get a short squeeze on a stock that's under $10 versus a short squeeze on a stock that's $200 because retail doesn't want to buy those stocks. The last thing I'm always looking for is options flow, which I'll go over later today as well. And that's because when I see big money pile in, they usually are correct about their timing. And that's how you know you're timing it right. Because a lot of times you see stocks with a high short interest, but they won't go anywhere. They won't do anything. And that's because there's no volume, there's no money in it. But when big money starts piling in, that's how I usually get a sense, okay, it's almost time for it to make a move. Another thing I wanted to talk about, stocks with high short interest actually do very well in their bear market rallies. So we all know we're in a bear market right now, but you notice on the days that we have those violent moves up, certain stocks actually make bigger moves than the S&P 500, right? So how do you find them? Well, these stocks with the highest percent of short interest and the highest market cap. So these bigger companies with large short interest, like Upstart, Wayfair, and did somebody have a question? Okay. So I thought someone had a question. Sorry, but these names tend to have like mini squeezes on these days, and I think it's very worthwhile playing these names. So somebody asked me, do you enter buying shares most of the time or buying options contract? So it depends. Uh, on stocks where there are no options, obviously I will buy shares. When there's no liquidity on the options, like the bid is 5 cents and the ask is 70 cents, I'm not going to get into an option because even if the stock goes up, that option might not move at all and there might be nobody to buy it. So that's another time I wouldn't enter an option. Uh, the third time I wouldn't enter an option is when it's overpriced. I'll get into that part later though, because I'll talk about overpriced options in a minute. So in these bear market rallies, you're looking for these stocks which have high market caps and high short interest because they'll run up a lot more than the S&P 500 and you can capitalize on that move, right? So Upstart with 30% short interest ran up 11%, Wayfair 35 up 10 and Carvana 35 14 while the SPY was only up about 1%, right? And that's because these shorts are getting out, they're all getting squeezed out. So what are some strategies you can use to trade, right? So number one, like I mentioned earlier, watching for options flow because especially on small companies, when big money enters, it's usually a sign of some sort of move coming because they're not wrong on their positions most of the time. Another cool strategy is a red to green move, which the stock opens red, but then the buying pressure throughout the day turns it green. It shows that there's buying pressure, especially on a name which is highly short. When that starts showing buying pressure, that's when you want to get in because that's when you know those shorts are going to start getting liquidated soon. So next, I want to talk about somebody asked me, do you like buying shares or option contracts, right? And part of the thing is I don't buy options when they're overpriced, right? So what does that mean? This is called margin of safety when your option has an your option has an intrinsic value and an extrinsic value. The intrinsic value is what it's actually worth. The extrinsic is the extra stuff. For example, the time, the IV, right? And a lot of times on certain names, the IV is going to be extremely high and it's not going to be worth it, right? So if you don't have a margin of safety, right? Like, let me give you an example. When we traded SST, the reason I went in pretty heavy on that one was because the stock was at $16 and we bought the $15 call for $1.05 each. So that means our break even price on SST was $16.05, and we had 2 weeks for it to make a 5 cent move for us to be in profit. So as you can see, we have a lot of safety there, right? It's basically tracking the stock exactly because the market isn't expecting it to make a move. But when we front load that move and we're able to capture it and the IV increases, that's when you actually see those big percentage gains. But if I'm buying a contract that's like the IV is 200% on any red candle, like my profit goes down the drain. So I'm always looking for contracts that are priced very near the price of the stock. I'm not looking for something where the stock has to make a 20% move in order for me to make money, right? It's just not worth it. So when I'm talking about shares, when you buy shares, there's a lot of ways you can strategize. For example, when we played Weber, the options contracts were pretty thin, right? They didn't have a lot of liquidity. So what you could do is you could buy shares with a 10% stop. If I were to buy an options contract, I would have, let's say, a 30% stop loss, right? Which means if I put in $1,000, I'm risking $300. Alternatively, if I'm buying shares, I can risk the same $300 by putting in 3,000 and risking 10%, right? So now if the stock goes down 10%, I lose 300. If I had options and it goes down 10%, I lose 300. But shares, right? When they start moving like options, now you're in 3 times the amount with the same amount of risk, which is why a lot of times they are good. And shares are just a lot more easier to trade. You can do market orders with them. Options, you can't really. That's not recommended. So let me show you how Ortex works. So Ortex is actually free this weekend because of July 4th. Now, I'm going to give a little disclaimer. I don't think you need Ortex like I actually canceled my account because all of this information is like free on Twitter. You can search up Ortex short interest stocks and somebody will have posted them for the day. So I actually canceled my account because there is no point. But let me show you like how I personally go through it. All right. So close out the chat here. So I go to the short section, shorts, and then I reset all the settings, right? Because I don't know what kind of settings they put by themselves. And then, all right, now we have basically all the stocks on the market. And what I'm looking for is, like I mentioned earlier, I'm looking for at least 20% short interest, like one over 100. Those come like once every 2 months, and those are my highest confidence trades. But otherwise, I'm just looking for above 20%, and I'm looking for a cost to borrow like above 100 here, right? Now I'm gonna sort by top. And here we have, okay, so these are our names, our short interest names. We have Redbox, which has already disclosed 1 time, or 2 times actually, if we look at the chart. Uh, sorry, like Redbox. You see, it already had a short squeeze once, came back down, had another short squeeze. So I'm not sure how much juice this has left in it to run again because, you know, then we have Rev. And basically, I'm looking here. This has 78% short interest and 515% cost to borrow. So I know a lot of shorts are in this, and I know it's very expensive for the broker to find, right? So this is a pretty nice looking chart. You can get your levels. You can see we bounced here. Over 650 would be my next trigger for $7.80. And I just browse through each of these charts until I find something. Sorry. And I just browse through charts until I find something that I really like, right? Because you have to look through them. Now, the next thing I'm going to do is I'm going to talk about how I use options flow to actually find. So I hope you understood about Ortex. Thing about it is, you can find all the information for free on Twitter. So personally would not recommend go signing up for it. But if you want to experiment with it, it's great. It's free this weekend for July 4th. So that's always there. But personally, I cancel my account because once again, it's free on Twitter. So there's that. Okay, next. Let's talk about using flow algo and cheddar flow. Options flow can really help us see where the money is going in the market. Let's take a look at how. Now, I have both of these. Personally, I think you can choose one, and if you were, you should choose Flow Algo, because this one, Flow Algo, is better for small caps. It tells you all these like smaller names, like the $3 calls, these smaller names, which I really like to trade, right? Whereas Cheddar Flow is best for looking at institutional money, and I'm talking like SPX, S&P 500, QQQs, like the VIX, Amazon, Apple. You know, they'll have these smaller names, but it'll have a lot more information from these bigger ones, right? All right. So let me show you how I use both of them. So Flow Algo, basically, I just watch throughout the day, and when I see unusual activity come in, right? Like I see CLVS, I'm seeing so many call sweeps for like the $3 calls, right? Uh, I'll pull up the chart, and you'll see that CLVS had a huge, huge day, and I can almost guarantee it had some sort of short interest to it if we just look, because like I was mentioning earlier, we're looking for high short interest, and we are looking for high options flow and a nice chart. This one had a really nice chart. If you look, this was just like perfect bull flag. Sorry, people are still entering, so I have to admit them. Not sure why it's not working. Yeah, so you can see the cost to borrow was 300%, and the short interest is 27%. So we had greater than 25% short interest, so which is pretty good, like 1/4 of the float. But 300% cost to borrow is probably what really had the biggest hold on this move, along with the big money entering, right? So you can sort by unusual. These are extremely out of the money and ones that expire soon. So you can just like look through them, and then I'll see like top, it's $6.57, but some of these mine the $8 calls for 2 weeks. So I'll look through the chart, and that's a really nice chart, right? It looks bottomed, lots of space above. Um, and you can see once we get above there, you can add some right here. That's your main trigger. You have some nice move to make above. So I just go through the flow and try and find like names like RFP. I just try to find names and see if they have like a nice chart, something that I would be wanting to trade. Now let me talk about how I use Cheddar Flow. So Cheddar Flow I use for these bigger names, but a lot of times if you sort by the spot price. So the thing about Cheddar Flow is really good for filtering out, right? Flow Algo not very good for filtering. It's good during the day. This is good for like doing some like research in the night, trying to figure out what you're looking for. So like CGC, I can see someone bought 23,000 of the next week $3 puts, right? For these two block trades. So you can see you just have to browse through the charts. FFIE. I think that was one of our names with some sort of high short interest, right? So see. And basically this is what I'll do. I'll just sort by and go through the chart. And then I'll sort by premium paid. So I want to look for the highest money. I don't like looking through SPX that much because there's just so much activity on there. It's hard to filter out. So I'll look through stocks. And then I will look for these unusual trades. So Meta, Okay, I was talking about this earlier in the chat. I know some of y'all asked were asking me about these deep in the money $360 puts when the price is 156.58, right? Why are they paying this much for a contract, right? So basically, what this can mean is that they're actually selling it and it's for risk purposes, right? Because if you're in a hedge fund, they're not going to let you buy out of the money out of the money options, right? That's just not how they work. They sell the out of the money options. But if we look at this and it's not bought above ask, see, it was bought near ask. So which means it wasn't actually bought, right? It could have been sold and it most likely was. When it has a delta of 1 and almost no theta, that basically means they're just trying to control, because one options contract holds 100 shares, right? So they're just trying to control a bunch more shares with less capital, right? And if we look at the meta chart, we can see that this is a really, really nice chart. We had a reversal candle the other day. It's right at support, and we can probably trade it back up to the top of this range at 172 next week, right? And maybe even higher, right? So, but then you can look at the out of the money options as well, right? So 210, 275. That's way out of the money and 20,000 contracts. So I would definitely be watching Home Depot for some sort of move to the downside, right? And you just have to, I just scroll through these. I don't look at this throughout the day. I look at this in the night, right? So there's so many, like I was saying, the meeting will end in 10 minutes. Upgrade now. Oh yeah. So in 10 minutes, I might have to put in a new link in the Discord and just join the same thing. We'll continue from where we left off. But yeah, basically, what I'm trying to say is you just have to find what's suiting you, right? Because I like using Flow Algo during the day. Some people may not like using Flow Algo at all, but I'm showing you what I'm doing, right? So you just have to like try it out and see what suits you, kind of. So somebody asked me about the scanners. Let me show you what scanner I use for small caps. So small caps, I go to finviz.com. Now Finviz, I think, is pretty underrated for like scanning, because if you go to the screener, these are my presets right here. So I'm looking for a price of a stock under $15. It's above the SMA simple moving average 50, right? And it's above the 200-day simple moving average. That shows it's in a bullish trend. So we're looking at stocks with relative strength, right? We're not looking at weaker stocks. We're looking at the smaller stocks that are doing well in our weak market. Average volume over 400,000. They have options and a float under 100 million, because the lower the float, the easier it is for it to make a move. You can also sort by candlestick over here. I know that's really cool. So what I do is I sort by percent change, because that's showing, or sorry, I do not sort by percent change. I sort by volume, because that shows which stocks had the most volume that day. And then you just have to hover over it and it shows you a chart. And I look for the ones with really nice charts. So Saiga right here, I know that's a monkeypox. So you can see, to make the watch list, I'm basically browsing in. And then a lot of times, if I see a really nice setup, so as you can see, this is an extremely coiled, nice setup here. So what I do is when I see one of our short interest names, like a name with high short interest, or a name that I saw got options will come up on this, I'll put it on watch, because I know, okay, so technically wise, it's fitting my scanner. Options wise, it's fitting that. And especially if it has short interest, then I know that this is fitting all three of my categories, right? So once again, these are my scanner settings. And then I'll just browse through, like that's a nice chart. I'll go to my, and I see, okay. And then like go through this. And then, yeah, that's how I use the scanners. So basically, once again, let me go over the short interest stuff, because somebody asked. So basically, to find what I'm looking for is I'm looking for stocks with high short interest over 100%, a cost to borrow over 100%. Now, when I say short interest over 100%, those are my most high confidence plays, right? Those are stocks I'm looking where like, okay, I'm going to go in a little bit heavier than usual because I'm confident, but I will always have my stop loss up, just in case it doesn't go the way I want. And another thing is only hold half size overnight because these high short interest plays, usually the companies are not very good and they can release like an offering or something of the sort to try and raise cash for the company, which is not good for your shares, right? So cost to borrow over 100%, share price under $10 and options flow. That's the recipe for most of my trades. All right. Does somebody have a question? No. Okay. Good. Uh, yeah. And then options flow, I see where these biggest trades are going, right? And then as you can see, I'm seeing like a lot of puts over here for like, let's see, big Bed Bath and Beyond calls. So I'll keep that on my watch list, especially since the price of this stock is $4, but the calls are being bought at $10. So I know that's really weird to see an institution loading up on such cheap calls. Yeah. And then like these small companies, $4 calls while the stock is $3.19, 10,000 of them. That's a pretty big trade, right? And then like TSM, I see for every one call, there was 8 puts. So TSM, I would be watching 4 puts, right? Even though it's kind of already extended to the downside a little. Now somebody asked how I enter, right? And let me show you. So one of the trades we took last week was Weber. And basically what I'm doing is number one, I'm waiting for volume, right? So the day before Weber kind of exploded, it had it had increased volume, right? And it was moving up pretty fast on increased volume. So if I go back all the way back, you can see it was the whole day, it was just a steady incline up. And I knew it because it was the number one it was the top shorted stock on the market. So when you are the number one most shorted stock on the market, all of retail pays attention to you and you most likely have a short squeeze, right? So this on this day was the number one most shorted stock in the market. Now it had a nice volume pop in the morning, right? It came down a little bit, came down. So I was like, okay, we just broke above this key technical resistance level, right? On that volume pop. It retested, it came back down. So we got in over here. Now, one thing I do personally is I think of everything in terms of risk to reward, right? How much risk am I putting for how much reward? So if we entered right above this resistance, we like at 827, and I set a 7% stop loss. That's my usual stop loss, 7%. And then our first resistance level was up here at 11. I already have a 1 to 4.5 risks to reward, right? Anything over 1 to 3, I think is personally worth taking. And then where we sold it was at our second thing, which was at 12, which was like a 1 to 6 risk reward, right? We sold at 12 for 1 to 6 level of risk reward. So basically, I determined my entries by saying, okay, if I buy right now and my profit target, like realistically, my profit target is over here, then is my risk reward above 1 to 3? And if it wasn't, like if at this point I was like, no, it's not, I wouldn't have taken the trade. Like I would not have entered right over here at $9.50, even though my profit target was 11, because just in the event I see that I would have to set my stop loss way, way below, right? So I use the 5 minute candle to confirm above a level. Like I let the 5 minute candle close or I let it close below a level to determine. But mostly I'm just thinking about, okay, if I enter here, how much risk am I taking on? And that's basically how I do it. Unless one thing is if I see like options flow when the stock is weak, like tomorrow, if I see which has a nice chart, right? As long as it stays like this is the trend line that I'm seeing here. And if I wanted to take a safe position, then what I do is if I see like options flow or something, you can enter right here, Set your stop loss right below the trend line. Okay. And then target this next level. And that's a 1-to-4 risk reward ratio, which is good enough for me.
Yeah.
I think someone has their mic on, which is okay. But yeah, does anybody have any questions? Oh, actually, there's less than a minute left. So I'm going to stop sharing my screen and I'm going to put a new link in the Discord if you want to join. All right.